Hi everybody, Thomas Moore at Rebel Income. Looking at the largest and most recognizable names in the stock market for useful dividend paying opportunities inevitably raises questions about the quality and sustainability of those dividend payouts at current levels. That's especially true when dividend payouts begin to increase in proportion to a company's earnings per share. Today, I'm turning my focus to Apple Incorporated, one of the largest companies in the world and easily one of the most recognizable names in the tech sector. Their dividend has been very conservative for the past few years. They first began paying a dividend in 2013. After steadily increasing it each year up to 2020, management slashed the dividend by more than 75% during the pandemic in order to preserve cash. Dividend increases since then have remained very modest in the extreme. I'm going to make a case for why I think Apple has room to increase their dividend significantly based on their current fundamental profile. At the same time, we'll look at the stock's current price pattern and consider what that means about the stock's bargain price. Before we dive into the details, I want to take just a minute and invite you to check out my Rebel Income Patreon page. I publish daily exclusive access content on this page, from stock reports detailing my analysis in search of the trades I publish for my trade alerts, to lists of underpriced dividend-paying stocks, and even weekly recordings discussing current open trading positions and current market conditions. You'll find the link in the description area of this video. Take a look. I know you'll find something that you'll be able to use in your own trades. Apple's fundamental profile is clearly very healthy, and it's manifest on multiple levels. For one thing, free cash flow has increased over the past year from about $97.5 billion a year ago to almost $107 billion in the most recent quarter. Keep that in mind. This is a company with a market cap of $2.8 trillion. Apple was the first company in the world to cross the $1 trillion market capitalization level. Cash and liquid assets are also extremely healthy, at $73.1 billion in the most recent quarter. That also represents a very sizable improvement from about $55.8 billion 12 months ago. It means we have very healthy cash flow as well as improving cash and overall financial flexibility. Apple currently carries about $99 billion in long-term debt. That has seen a modest increase over the last year from about $97 billion. Considering the level of cash that they are currently carrying, as well as their healthy cash flow levels, there's certainly no concern about their ability to service their debt. That opinion is reinforced by looking at their overall margin profile, which I like to measure by comparing the company's net income to their current revenue. Over the last year, net income was about 26.16% of revenues, which is an extremely robust number. It increased to about 28.36 in the most recent quarter. That's also a very healthy improvement over that period. This reinforces the idea not only that they can continue to service their debt, but they have a lot of financial flexibility both to pursue acquisitions as well as to return value to their shareholders in the form of either stock buybacks or, as a lot of investors like me prefer to see, increased dividends. To put their dividend in perspective, we can look at the current dividend payout of 96 cents per share against their current price of $178 per share to see that they have a very modest dividend yield right now of just 0.54%. This is a very conservative level. To be frank, it makes it hard to take Apple's dividend very seriously at all. It also does follow a relatively consistent pattern for Apple in terms of maintaining a very conservative dividend payout. This chart represents the last 4 years of dividend payouts for Apple. We can see very modest improvements in the early part of each year have brought the dividend payout to its current level at 96 cents per share. That's the number that I have here on the right. Number on the left is the total earnings per share for the past 12 months. That's $6.42. The reason this number is important is because it allows us to evaluate what the company's dividend payout ratio is. The math is very simple. We divide 96 cents by $6.42, and we get a total payout ratio of 0.149, or about 15%. A very typical dividend payout ratio for most stocks in the S&P 500 is usually anywhere between 25 to 50%. So Apple Computer's dividend payout ratio is significantly below that of its other brethren in that index. Paying out a dividend represents a financial commitment to shareholders, and that is usually paid either from cash flow or from available cash. So let's consider exactly what that payout really looks like in practical terms. Apple has approximately 15.44 billion shares outstanding right now. With that in mind, we can calculate the total size of their annual payout by multiplying 96 cents per share by 15.44. And that gives us a total payout of $14.82 billion. Now, that is significant. However, when you consider the fact that the company's free cash flow over the last year was nearly $107 billion, and the company carries more than $73 billion of cash on the books, we can see that that doesn't represent a significant obstacle to the company's overall operations. I mentioned earlier that a typical payout ratio for stocks in the S&P 500 is from about 25% to 50% of their earnings over the last 12 months. With that in mind, let's consider what it would look like if Apple were to increase their payout ratio to the low threshold of 25%. $6.42 earnings per share over the last 12 years multiplied by 25% would translate to an annual dividend payout of $1.60 per share. We take $1.60 and multiply it by 15.44 billion shares, we get a total payout now of $24.7 billion. This is a larger commitment by nearly $10 billion. But again, considering the level of cash flow the company has, the robust nature of their profit margins, and their increasing cash, even paying out $25 billion would not represent a major hardship. The other argument for an increased dividend payout relates to trying to attract long-term investors to buy and hold your stock. One of the reasons that a lot of long-term investors do like to buy and hold some of the largest companies in the world, like Apple, is because of the opportunity to generate passive income in the form of dividends. That means that paying an attractive dividend works in the company's favor because it motivates long-term investors that are less likely to trade their shares actively in and out on a regular basis. That is harder to do when the company pays a very minimal dividend, such as what Apple is currently doing. It's also harder to do when a stock is beginning to experience a significant drop in price. And as we can see, Apple Computer has been falling from a peak in December at around $197 per share to its current level at about $178 per share. Now that's a decline of about 10% from that high at this point. The more interesting element of this is the way that bearish momentum is beginning to increase. Over the last couple of weeks, the stock has dropped below the 200-day moving average, which is an indication of the stock's long-term trend, signaling a very likely reversal of the company's long-term upward trend. We also can see the 20-day moving average, which is an indication of the shorter trend, also beginning to move lower and looking like it's in position to cross below the 200-day moving average. That's also a technical signal. The bearish downside in Apple is much higher than what its current opportunity may be. This is an environment that makes it hard for long-term investors to want to buy and hold a stock over any extended period of time. It's easier to make that argument if, in fact, the company pays out a healthy dividend. It also helps if the company happens to offer a useful value proposition. In the case of Apple, however, my current analysis shows their fair value target price right now is at around $150 per share, which is about 15.5% below the stock's current price. I would actually consider Apple to be a compelling bargain at around $120 per share, which is nearly $60 below the stock's current price. As a value investor, that means that Apple is not a stock that I'm going to be interested in trying to use right now. If you're a long-term investor looking for attractive income generation, it's also hard to justify buying and holding Apple Computer on a long-term basis simply because of the very conservative nature of their dividend payout. So come on, Apple, why not go ahead and increase your dividend right now? You'll attract some good long-term investors, and it's not going to hurt you that much. Thanks everybody. I hope this has been useful. If you like my content, please click here to subscribe to my channel. You'll get notifications each time I publish a new video. You can also learn more about my Rebel Income investing system by clicking on the video shown right here. Thanks again. I'm Thomas. Talk to you again soon.